Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in. Hello, and welcome back to another episode of the AAA Storage Podcast. I have with me, as always, Paul Bennett. Thank you so much for joining. So today we are going to be talking about single-story drive-up self-storage. So the reason we're talking about this today is there are lots of different self-storage types out there, formats, when you think about investing in this real estate asset class. And you guys, AAA Storage, specialize in self-storage that is single-story and a drive-up, those two things being a part of what these units actually look like. And there are reasons for that. There's operational reasons for that. There's construction reasons for that, and obviously all of that impacts the investment returns on this particular format. So today, Paul, you are going to talk to us about why this type is so important when you think about the way that you guys invest in these, build these, and how you create this process for the returns for investors. And of course, it has some benefits for consumers as well. So I'll let you give us a go, start us off.
Yeah, I thought it'd be fun today to kind of compare the two major different property types in the self-storage industry. Today, we're seeing people buy old big box stores and divide them up, and that's sort of single story, but a different product, all climate control. But the two main property types are multi-story self-storage and drive-up self-storage, single-story drive-up. I'm going to try to do something, Brandon, I've never done on the podcast before for those that are watching this and not just listening to it. I'm going to pop up a couple pictures because when somebody hears the term self-storage, if you're my age, more than likely what you're going to think of is the product that we build. However, if you're 30 years old today, you might think of something totally different. So I quickly grabbed some pictures. This is just a Google search, but this is multi-story self-storage. And there are several examples here on the page. I think that's a 5-story building here, the larger picture. The most common is 3 to 4 stories, but they're usually brick exteriors. They obviously have elevators and sprinklers and kinds of all other things. And this is a quick look at the product we build, which is a single-story drive-up. This is actually phase 1 of a project in Cibolo, Texas, that has been developed by our Growth Fund 1. You can see the vacant land there inside the fence behind that facility. That's where phase 2 is actually under construction right now. This picture is from about 8 months ago. But that just gives you a quick visual. Single-story drive-up is the traditional, original version of the product. These buildings that you see, the larger buildings actually have climate control units on the interior, and the exterior doors that you see are drive-up non-climate control units. And then there's some more non-climate control units right there along the fence with their back to the road. But go back to our normal screen here. And so what I want to do is walk through 4 different aspects of these two product types and talk about why we've chosen to exclusively do single-story drive-up self-storage. The first category is in design and construction. And I want to be really clear about something. Land cost is what drives the decision to do multi-story or single-story in almost every case. The product we build, we develop in city skirt markets. So, for example, when we say we've got projects in Austin, Texas, almost none of them have an Austin address. We're in Hutto, Texas. We're in Dripping Springs, Texas. We're in Georgetown, Texas. We're in all the suburban bedroom communities that feed Austin and are supported by Austin. If you're going to build a self-storage facility in downtown Austin, it's almost got to be a multi-story building because land cost is so extraordinarily high. A project like we build would never make economic sense. So there certainly is a place for multi-story. However, as an investor, we think there are numerous reasons to choose to invest in single-story drive-up versus multi-story. So let's talk about them for a minute. But I just want to cover at the outset, I'm not saying that multi-story product is a bad idea. It just has some disadvantages that we think from an investment standpoint make the drive-up product that we build a little more attractive. The first thing from a design standpoint is unit mix. In our facilities, like the one I showed you a minute ago, we have a mix of climate control and non-climate control units. In a multi-story facility, they're all climate controlled. However, I will guarantee you, if you went to any multi-story facility in the country today, they are renting some of their units at non-climate control prices because they can't fill it with all climate control oriented customers. But you can't create a unit mix in a multi-story building between the two types. The other thing is size mix. We build everything from a 5x5 to a 20x30 size unit in our facilities. And by the way, the bigger units almost always rent first. Not quite sure why that is. Maybe it's business users who want a little bit more space, but in a multi-story building, the unit mix tends to trend smaller, more 5x5s and 5x10s and 10x10s and less larger units. So you get some flexibility with a drive-up product in terms of how you design it that you don't get in the multi-story building. The three most important differences. Number one is the multi-story buildings are a much more complex construction. They're usually brick exterior. They're multi-story, so the fire marshal is going to require sprinklers. They have to have elevators. They are significantly more complex to build. And what that means is that the instances in which there is a significant deviation from your budgeted construction cost, and that those deviations are also far more likely to be larger to the point where they can impact returns significantly. So there's a lot more construction risk in developing a multi-story facility. Second aspect is that there's significantly higher construction cost. We're building our single-story drive-up at about $100 a foot. The average multi-story project probably costs in the $150 to $160 a foot range. So they're much more expensive, and we'll talk about that a little bit more at the end of the podcast, but that's a significant difference. The other thing that is pretty different is the ability to phase projects. The picture I showed you a minute ago, we built phase one. We're now building phase two because phase one is about 70% leased. In a multi-story building, obviously you can't do that. You got to build the whole thing at one time. And you might ask why that matters. Self-storage lease up takes about 3 to 4 years in total, including construction along the way. And so if we're building an 80,000 square foot facility, we know the second 40,000 square feet isn't going to be touched for 2 years. In a multi-story building, you got to build it all and carry that cost for 2 years until you get the first 2 floors filled up, and then you're working on leasing, floors 3 and 4. We're able to phase our project, so we build 40,000 square feet. We don't incur the cost. We don't have the carry with the bank. We don't have all the added cost until we've got phase one leased up to a point where the next units that start to lease are going to be in phase two. So it really does make a difference in the working capital that's required to fund a project when you can do it in phases. And so those last three really have to do with cost, the complexity of construction and permitting, the obvious higher cost, and then the inability to phase it and control the working capital needs all affect the amount of money that has to go into the project. And I think unless you're talking about building in a inner city or a very high density market, which we can't do because we need 4 acres of land, and if the land's $1 million an acre, that alone destroys the economics of a project. So there are places where the multi-story project makes perfect sense. But as an investor, you get the opportunity to choose. The next area to talk about is operationally. Multi-story buildings have significantly higher maintenance costs. They have elevators that have to be serviced. They have sprinkler systems that have to be serviced. They have, interior finishes. They're not fancy. They're very durable, but it's a different product. Also have higher CapEx expenses during ownership, things that get damaged, things that have to be replaced, things that have to be upgraded. And overall, the drive-up product is a much simpler product operationally. We're building slab-on-grade metal buildings. The worst that can happen for us is somebody cuts a corner too close and hits the corner of a building. And even that's not a terribly expensive repair. It's, metal panels that can be, replaced. So operationally, I don't think there's any doubt that the drive-up product is just a simpler, easier product to operate. The next category is one that is not as absolute, but drive-up is more user-friendly. I tell our director of property management for self-storage, David Lutz, all the time, I want to see him do a billboard, particularly in the markets where we're competing with some of the REIT-owned multi-story facilities, which we compete with on a really regular basis. I want to see a big billboard with a picture of a guy kind of buried under a sofa trying to stuff it on an elevator to get it up to his third floor unit, and with AAA Storage and an arrow pointing to our facility, on the other side of the billboard. Unfortunately, I don't know that a lot of consumers think about that, but they certainly think about it when they start to move their stuff into a multi-story building. And they got to wheel a cart out into the driveway and load the stuff and then push it in the building and jam it on the elevator. And the drive-up product's just more user-friendly. There's just no doubt about it. Another thing that's interesting, as I thought about this podcast today, it occurred to me, we have a tremendous amount of business users. Businesses that store inventory in a storage facility. We have landscapers and other similar types of businesses that actually operate their business out of a self-storage. They keep their lawnmowers in the self-storage facility, maybe the fertilizer, other stuff, and they come in and out every day. A multi-story facility is not getting those customers. It's too inconvenient to go in and out every day. So there's a whole segment of the market that's actually a very valuable segment for us because those are long-term tenants. They don't have a unit in your facility because they're renovating their house and they're going to be done with the renovation in 6 months. They're running a business. And we have tenants that have been with us for years that run their business out of a self-storage facility.
My brother does that. He owns a Christmas decorating business in Tampa, Florida, and he's got a big storage unit, and he drives up every day and runs his business out of that thing.
Yeah. A perfect example, Brandon. The other thing that's developing in the marketplace, although I really don't have any data on this, but we're seeing younger families really use self-storage as an extension of their garage or their home. If you think about the affordability issue that everybody's been talking about, for the last year, houses have gotten really expensive, and the result is they've gotten smaller and they have less storage space in an attempt to make them more affordable. So what we're seeing is millennials and Gen Xers and people younger than I am are buying a house and they don't have room to store their toys. So they're renting a self-storage facility to put their skis in, their jet ski, their motorcycle, their all the stuff that they don't have room to store. And those, again, are users that are in and out more frequently. So a multi-story facility just wouldn't work for them at all. It wouldn't be convenient at all. I will say this about multi-story, and that is it's generally closer to density, population density. It's generally, closer to the rooftops and where people live. And therefore it has a convenience edge in terms of location, because it is, like I said, by nature, typically built in higher density markets where land is more expensive. But the reality is there are some very real consumer-facing advantages to the drive-up self-storage product. I mentioned this a minute ago, but also, when you've got an all-climate control facility, not everybody, we're typically about 60-40. It kind of depends on the market. In Florida, where the weather is so terribly humid and hot, we tend to build more climate control units in one of our facilities than non-climate control. In Texas, it's pretty balanced. You 60-40, 50-50, depending on the market. But it's also one of the advantages that we get from phasing our projects. We will design a project with that mix based on what we think the market is, and then we'll watch up what leases up during phase one lease up. And that gives us a lot of real data, not guesses, on what the market is demanding. And we can always tweak the design in phase 2 before we build it to make sure that it's delivering the mix of climate control and non-climate control units that the market it really wants. So those are the 3 sort of practical differences in multi-story and drive-up self-storage. And like I said at the beginning, multi-story is a valid product. It works very well in some markets. But here's where it really separates from me, and that's on investment returns. And you know where I'm going to go, Brandon. I'm going to go to yield on cost.
That's right.
And because our focus is to develop projects that have the highest possible yield on cost, because they create the most incremental value in the development process. And as I've said 100 times, we underwrite to a 9.5% yield on cost. In the multi-story world, because they do get a rent premium over what we charge, it really depends on the market. If the market is competitive, they're probably not getting any rent premium. But in a more mature market that's doing really well, they can get as much as a 20-25% rent premium on their climate-controlled units over what we get. It's interesting to me that it's less convenient, but they charge more for it. But anyway, somehow or another, that they're able to do that. But
population density.
But when we're building at $100 a foot, and they're building on the low end at $150 a foot to $180 a foot on the high end. So call it $160 a foot. So when their costs are 50% greater than ours, but their rents are only 20 to 25% greater than ours, we're at a 9.5% yield on cost. They're somewhere between 7.5 and 8. And so there's 100 to 200 basis point difference in that yield on cost. And it produces a very significant difference in the amount of value that's created in the development process. I jotted down some numbers, that's why I'm looking down, but that alone is sufficient to justify, from an investment standpoint, focusing on single-story drive-up product, which is it creates higher returns. And to be honest with you, I don't think there's a material difference in the lease-up. It's all going to be market-driven, as we've talked about on an earlier episode. It's a hyper-local market issue in terms of the speed of lease-up and how much demand and how much supply there is in that hyper-local market. So at the end of the day, you could argue on both sides for either product, from a design construction basis, from an operational basis, from a consumer marketing basis. But from a pure investment return standpoint, while carrying less construction risk, which is what you get the risk premium in development for, is the construction risk. While carrying less construction risk, drive-up self-storage generates consistently higher returns to investors. And that's why we've stayed focused. We built one multi-story project in our 32-year history. And I think when we got through with it, we said, wow, we'll never do that again. And we stuck to our city skirt market strategy around major metro areas and the drive-up single-story product that we build and have made lots of money with. So,
yeah, interesting. It makes me think of the images that you were showing just down the street, half a mile from my house. There's a big multi-story, 2 or 3, 4-story storage facility. But then we've been down to Dripping Springs and Georgetown and some of these markets that you're talking about outside of Austin, and you do see a lot more of those single-story drive-ups. But to me, that doesn't seem like there's a big difference between the type of folks that might be customers, because here in Fort Worth, you've got a lot of folks that use that big, the big multi-story. But down in Georgetown and Dripping Springs, you got these beautiful homes, beautiful neighborhoods, and people driving around with their boats and things like that, putting all their stuff in those markets. So yeah, it's kind of interesting that it can be same markets, but much better investment returns on one of them. Yeah,
the returns are better, and I'm not going to pull the picture up again because I know most of our listeners are listening, not watching the podcast. But we build. There are mom and pop drive up facilities out there that have gravel driveways, and they're not the buildings are old, they're not well maintained. I mean, we build a Class A product. If you noted, and our drives are all concrete. It's more expensive, but it holds up better. It looks better than asphalt does. Certainly better than stone. I mean, we build a quality product.
For sure.
But it just from a return standpoint, the multi-story product just can't compete. And as evidence of the fact that they're aware that they're at a disadvantage from a convenience standpoint, we're starting to see a number of drive-through multi-story self-storage projects, which is basically they've created a tunnel in the middle of the building on the first floor where you can drive in and then unload your stuff into the lobby and then go park the car and then jam it in the elevator and, take it up 3 floors.
Yeah. Anybody who's ever moved into an apartment knows that's still terrible.
Yeah, it's horrible. And so, again, fun. Obviously, a little bit of a selfish perspective because we have focused on the single-story drive-up product. But as I said, I think everything I just laid out is factual. And I think if you put all of that on the scales, given a choice, as a developer, I would choose drive-up every time. But there are situations where if you have a piece of land that's very expensive and you can build a single-story, a multi-story project on 1 to 1.5 acres pretty easily. Because it doesn't require a lot of parking, doesn't require, just a building footprint, basically. We need 4 acres to, up, depending on the size of the project. So there are absolutely instances where multi-story makes sense. But as an investor, you have the ability to choose which you invest in. You're not a developer. And from a return perspective for investors, multi-story will never outperform drive-up, single-story drive-up self-storage because of the basic economics and yield on cost.
Yeah, that makes sense. Yeah, here, I think it's got to be $1 million an acre or more. Maybe $2 million an acre here. So yeah, I can't imagine that working out very well.
Yeah, $1 million an acre is gonna equate to about $24 a square foot in land cost. And depending on the size of the building, the footprint. Our land costs vary between $2 and $6 a foot.
Oh wow. Okay. Good to know.
So $6 a foot's about $250,000 an acre.
Okay.
And that's about the high end of where our land costs will generally be. We've got projects in Fund 2. Gastonia, North Carolina, our land cost is $2 a square foot.
Okay. This is making more sense.
$80,000, $90,000 an acre.
I love, you mentioned the other episode we've done on hyperlocal markets, and because you're very, very particular about which markets you enter into and looking at traffic data, among many other things, how people are moving in and out of the city or the town in which the facility is operating. It's fascinating how, of course, there's a land cost and all of that, but how are people actually using that space or moving around that space? And you guys do really, really detailed work on, just all the demographic data and demand data and all that kind of stuff that goes into each of those markets. So that's definitely a great episode to listen to that would help correlate how the economics work out for these single story units.
Yeah, I was on a call yesterday with Logan. We were looking at a piece of land in Texas. And the land we were looking at was outside the city, sort of where the city is growing and the direction it's growing. But all of the competitors, and there were a number of competitors, were closer into the city and along a major thoroughfare, Highway 290. And when we looked at the site, it could be a good site in 5-6 years, but it is not a site that's ready to be developed with self-storage today because the main density in the population, your existing competitors sit between you and that density, and they're not going to drive by your competitor to come rent a unit from you. And so unless those guys are all 100% occupied, you've got a fight on your hands if you go, in this case, it was north. If you go north of where they are, because now they're in between you and where all the rooftops are. Yeah. And that's hard to overcome. That's a market you just have to sidestep or buy the land and sit on it for 4 or 5 years before you develop.
Yeah, which you guys often do that, land banking the land and kind of sitting on it for a little while. Is that what
Yeah, but we try to avoid markets where it's that long a time frame before we feel like that's really what we do is absorb the pre-development time frame, all the site design, permitting, all the stuff which takes a year and a half. So we try to buy land that we feel real good about developing in 2 years. That's really sort of how we think about it.
Okay, great. Awesome. Okay, anything else that you want listeners to take away on why this product is just a great investment opportunity and this kind of in the mix of self-storage assets?
No, I think we covered it. Hopefully I covered it fairly well.
Yeah, great.
A little bit of a shorter podcast today, but that's fine.
Great.
But at the end of the day, there are advantages in all the categories that I mentioned, and the final sort of knockout blow to me is the yield on cost the ability to generate incremental value through development. And that's our focus. It's been our focus for 32 years. It's our focus in Growth Fund 2. So if this has gotten you interested in investing in self-storage, I would recommend you go to our website, AAA storageinvestments.com. There's other information there. There's some information on the fund. There's also an information tab where we links to all our podcasts and blog posts and newsletters and a lot of stuff you can dig around in, and a way that you can contact us if you'd like to schedule a call or get some offering material on Growth Fund 2. So the website's sort of the hub of the universe from our standpoint, and invite you to go there and check out that information. So.
That's right. And do sign up for the newsletter. After every episode, we distribute the newsletter on the summary of the episode. That way, if you don't want to listen to the whole thing, you can get the gist of Paul's arguments about certain things.
The Cliff Note version.
The Cliff Note version, yes. So, and then there's often live webinars that Paul's a part of that leads. And if you have investor questions or anything like that, please look at the events tab on the website, and you can go register for an upcoming webinar to hear directly from Paul.
Yeah, we did a really fun webinar yesterday. I know we need to go, Brandon, but we did a really fun webinar yesterday that I was so excited about. We're going to probably do it again in about 2 weeks. We did a lot of research on allocations within real estate investment portfolios and the impact of not allocating all of your real estate dollars to existing assets, which is what most high net worth investors tend to do, either because the cash flow they produce gives them comfort or they just perceive it as less risky than development. And we make a pretty compelling case not to only invest in development, but to strategically balance the portfolio with some development and some existing properties. And it's really fun stuff. And I had a bunch of fun doing the research and doing the webinar yesterday. And just keep an eye out, because I think we're going to probably redo that webinar in a couple of weeks. We had a huge crowd and several people that wanted to be there, but were otherwise tied up. So I think we're going to do it again in a couple of weeks. And so keep a lookout for that on the events tab. Or if you're on our mailing list, we'll send you an invite with a link to register for the webinar in a couple of weeks. So.
Yeah, that's great. Okay, awesome. Yeah, I'd love to see round 2 of that, how that goes.
Yeah.
Well, Paul, thank you very much. As always, I love your expertise and your wisdom in doing this. I know you guys have been very focused on this for 30 years, and it's been a great strategy, provide a lot of returns to your investors over time. So I know it works. So it's cool to see how you guys break this down. So thank you very much, and we will see you on the next episode.
Thanks a lot, buddy. Have a great day.